Every year, assisted living owners lose thousands to the IRS, not because they did something wrong, but because their facility is treated like a regular business when it's not. I am Larry Davis, founder of Tax Help. We help business owners to clean up their book, reduce their tax bills, and finally get control of their finances. Running an assisted living facility means constantly juggling moving parts. Care standards, staffing demands, compliance deadlines, medication tracking, family communication, and unexpected maintenance costs. But there's one challenge most owners never prepare for: the IRS. Every year, thousands of assisted living owners unknowingly overpay taxes, not because they did something wrong, but because traditional CPAs simply don't understand how healthcare facilities operate. They treat assisted living businesses like standard LLCs, failing to use care-related deductions, payroll structures, and legal tax frameworks that could keep tens of thousands inside the facility. We recently helped a facility bringing in $850,000 in annual revenue, yet they were paying over $120,000 in taxes because their strategy was built for normal businesses. Once we applied a healthcare-specific tax framework, from payroll restructuring to cost segregation to categorizing medical-related expenses properly, we legally saved them $47,000 in the first year alone. The real truth? Assisted living facilities don't have tax problems, they have structural problems. In this breakdown, I'll show you 10 overlooked areas where assisted living owners consistently lose money to the IRS, and how simple restructuring can turn confusion into confidence and chaos into control. Let's begin. Ignoring tax planning. One of the biggest financial mistakes in assisted living is treating taxes as a once-a-year event. Many owners wait until their CPA calls and tells them what they owe, and by that time, it's too late to fix anything. We worked with a facility earning $90,000 per month. For years, they waited until tax season to see what was left. The year we reviewed their books, their tax bill was $38,000 higher than expected, forcing them to borrow from payroll reserves just to cover the IRS. Morale dropped. Retention fell. They even skipped maintenance projects for 3 months to recover. We implemented a monthly tax forecasting system, projecting tax liability based on real-time performance and allocating a fixed percentage of revenue into a dedicated tax reserve account. Within 60 days, tax season became predictable. Within 6 months, cash flow stabilized. The lesson? Assisted living finances are predictable, but only when visibility exists. If you don't plan taxes monthly, the IRS will plan them for you, and they won't be gentle. Unclaimed healthcare-specific deductions. Specific deductions are left unclaimed. Assisted living businesses have care-related expenses that qualify for industry-specific deductions, but most accountants never classify them the right way. One facility spent over $62,000 on patient tracking software, care compliance upgrades, medical charts, and safety training. Their CPA reported everything under general admin expenses. As a result, they overpaid the IRS by over $14,000. We restructured their expense tracking into IRS-approved healthcare deduction tiers, including patient wellness tools, safety improvements, compliance-related costs, and specialized training programs. They didn't change their spending, we simply changed the language of their bookkeeping. In just 1 year, their qualified deductions increased by nearly 30%. What most owners don't realize is this: the IRS doesn't need new information, they need better organization. If your books don't match industry tax codes, you're already losing money, even with a good CPA. Assisted living finances are predictable, but only when visibility exists. If you don't plan taxes monthly, the IRS will plan them for you. Payroll structured incorrectly. Payroll is one of the biggest tax traps in assisted living. Many owners pay themselves like regular employees full W-2 compensation, which triggers unnecessary payroll taxes every single year. One owner paid herself $200,000 annually as a standard employee. After reviewing her structure, we discovered she had been overpaying taxes by $18,000 every single year. We restructured her business under an S-corp model, paying herself a reasonable salary while converting the rest of her compensation into owner distributions, which are taxed more favorably. This strategy is fully IRS approved when documented correctly. With this shift, she increased her personal income without earning a single extra dollar. This is one of the most powerful tax strategies for assisted living owners, yet most are never shown it. You should not work harder just to give that money to the IRS. Your paycheck deserves a tax strategy, not guesswork. Poor expense categorization. The IRS rarely denies expenses. They deny the way expenses are categorized. One assisted living facility owner used a single tax category labeled operating costs for most expenses. Nothing was technically wrong, but because the expenses weren't categorized strategically, they failed to qualify for specialist deductions, losing over $22,000 in potential tax savings. We created a color-coded deduction system using 4 categories aligned with healthcare tax standards: compliance and regulation, patient care and safety, administrative improvements, and tax-deductible investments. The best part? They didn't change their spending at all. They just organized it better. When your bookkeeping matches IRS language, deductions unlock automatically. You don't need to spend more, you need to structure better. Manage growth taxes. Growth is exciting until the tax bill arrives. One facility increased admissions by 40%, but their tax bill jumped by 70% because they didn't adjust their tax structure as the business expanded. With growth comes opportunity, but without preparation, it becomes burden. We introduced a growth tax strategy map, converting growth-related expenses into scheduled deductions and capital improvements. By timing purchases and categorizing them correctly, we lowered their taxable income while preserving cash flow. Over 12 months, they saved over $31,000 in taxes while still expanding successfully. In assisted living, growth is not the problem. Growth without structure is. Retirement planning. Most assisted living owners think retirement plans are only for the future, when in reality, they're one of the most powerful tax tools available right now. We worked with a facility owner earning $240,000 per year who had no retirement plan. We introduced a defined benefit plan which allowed her to move $50,000 directly into retirement, tax deductible, immediately lowering her taxable income. Her retirement balance grew, her tax rate dropped, and her financial security improved instantly. Retirement planning isn't just about later, it's a tax strategy for today. If your retirement plan is not aligned with your tax plan, then both are incomplete. Real estate missing cost segregation. Many assisted living owners own their facility building, which qualifies them for cost segregation, a specialized tax method that accelerates deductions for building components. One owner operated his facility for 7 years without ever using this strategy. After a cost segregation study, we reclassified multiple components, including flooring, medical fixtures, lighting, and security installations, as accelerated deductions, saving him $68,000 in taxes in just 1 year. Cost segregation isn't risky. It's one of the most powerful IRS-approved strategies for owners who own their building. Most are simply never told it exists. Mixing personal and business finances. Some owners still use one card for both business and personal spending, and that single mistake can destroy deductions and create audit risk. One client used their personal card for business expenses, making it nearly impossible to prove what was deductible. We helped them separate finances into business accounts, owner distributions, structured payroll, and reimbursements. Once everything was separated clearly, deductions became easier to claim, financial decisions became clearer, and peace of mind returned. You cannot control what you cannot measure, and in assisted living, disorganization is expensive. No quarterly reviews. Most owners only review finances once a year, and that's where tax mistakes multiply. We helped a facility earning $1.2 million annually implement quarterly financial reviews. Every 90 days, we checked tax liability, expenses, payroll, and deductions, and corrected issues early instead of paying for them later. Over 12 months, we found more than 30 adjustments that improved profitability and lowered taxes. In assisted living, real problems don't begin with major mistakes. They begin with small issues that go unchecked. Quarterly financial checkups are like health checkups. It's how you prevent bigger problems down the line. General CPAs are costing the most money. The most expensive mistake many owners make: using a general CPA instead of a healthcare specialist. One owner worked with the same accountant for 8 years, but after switching to a healthcare-focused tax strategy, she saved $52,000 in her first year alone. Assisted living has compliance-driven deductions, staffing-based tax structures, and care-related benefits that general accountants simply don't understand. You don't need just a CPA, you need a tax strategy partner who understands your industry. Assisted living owners aren't overpaying taxes because they're careless. They're overpaying because their industry is misunderstood. The IRS isn't the enemy, lack of structure is. When your tax strategy aligns with the way healthcare facilities operate, everything changes. Deductions open up, cash flow strengthens, payroll becomes strategic, and tax season becomes predictable. The solution isn't to work harder, it's to structure better. Your facility deserves a tax strategy built for healthcare, because when your finances are healthy, your business can truly focus on care. If you're an assisted living facility or a healthcare business owner overwhelmed by tax confusion or financial chaos in your business, subscribe right now. Every week I share real strategies to legally help you reduce what you owe. Also, we'll send you our 10 tax strategies for assisted living and healthcare businesses to reduce their tax bill just for liking this video.